Alright, in this video we're going to talk about payroll liabilities. Payroll liabilities are amounts that we owe related to our payroll. So here we have an employee. His name is John. His job is complicated, but he gets paid $30 an hour. He's single. He hasn't elected any allowances, and he gets paid weekly. What does all of that mean? Well, let's talk here briefly first about what we've done with payroll up to this point in our video series. When we've looked at payroll, we have recorded a very simple journal entry. And our journal entry has been wage expense for whatever amount we owe someone, and a credit to cash for that amount. Now, this journal entry is very oversimplified. Payroll is a lot more complicated than that. And so we're going to look at what's a little more realistic in terms of payroll accounting. So let's just say, for example, that Mr. John here gets paid $30 an hour, and during the work week he works 40 hours. What does that mean in terms of his earnings? Well, if this were the case, he would earn $1,200 per week. Now, is he going to walk home with $1,200 each week? Unfortunately, he's not. We have to consider what gets taken out of people's paychecks. And so we have to learn about some taxes. We have what are called FICA taxes. FICA taxes, FICA stands for the Federal Insurance Contributions Act. FICA taxes fund two government programs. They fund Social Security and they fund Medicare. Social Security is retirement. It's a retirement program. Medicare is health insurance. Both of these are generally for elderly folks. But FICA taxes come out of most individuals' paychecks. FICA taxes, Social Security, is 6.2% of your earnings, up to $132,900. So you will pay 6.2% on your earnings until you earn more than $132,900, and anything you earn beyond $132,900 is not taxed for Social Security. For Medicare health insurance, it is 1.45%, and there is no limit. Okay, no limit on how much you make. Everything gets taxed. Now, those are FICA taxes. But in addition to FICA taxes, you are also going to have withheld from your paycheck federal income tax withholding. So, federal income taxes. Now, you probably also will have state income tax, but these videos are not state specific. But federal income tax. Government requires your employer to withhold from your paycheck the amount that's appropriate for income taxes for you based on your scenario. Everyone is different, And so it all depends on your information. So when we do federal income tax withholding, the amount that's withheld is based on a couple of things. It is based on how frequently you get paid. Do you get paid monthly, weekly, bi-weekly, bi-monthly, whatever, semi-monthly? It's also based on how much you make. So how much money? It is based on your marital status. And it's based on the number of allowances you've chosen. So we need to know those things. So we're going to go through an example here, and we're going to do some accounting for payroll. Now, with Mr. John, he has $1,200 each week, is what he earns if he works 40 hours a week. So some of these are fairly simple to calculate. Okay, we can calculate his FICA tax. Okay, if he's earning $1,200 a week, we take that times 6.2%, and we are going to withhold $74.40 for Social Security. If he's earning $1,200 a week, 1.45% for Medicare, we're going to withhold $17.40 for Medicare. And so each week, if he's earning $1,200, we're going to withhold $91.80 in FICA taxes. Not too difficult to do the math there, as long as we know the percentages. And as long as he's below, right, the limit for Social Security. For income tax withholding, it's a little bit more complicated. So, for federal income tax withholding, we need to know a couple of things. We need to know payment frequency. And we see that he's paid weekly. So that's one thing we need to know. We need to know how much. So how much money? And it's $1,200. We need to know his marital status. Married folks pay less in taxes than single folks. There's a lot of history behind that, but that's the way it is in our society. So, marital status, he is single. And fourthly, how many allowances? Now, we said that there were 0. Now, but let's talk about what are allowances. So I'm going to scroll down here a little bit. When you hire on to a new company, you are asked to fill out a W-4. The W-4 is the Employees Withholding Allowance Certificate. According the W-4 is the Employees Withholding Allowance Certificate. Withholding allowances are a way to tell your employer how much income you expect to be exempt from income tax in advance of filing your tax return at the end of the year. So, we're talking about how much we think will be exempt from tax. For each allowance you claim, your employer will take less tax money out of your paycheck. Each allowance lets you claim that part of your income isn't subject to taxes. So if you're eligible to claim more allowances and more of your income isn't taxed, you'll have more money left in your paycheck. Basically, if you are single and have no dependents, then 0 is what most people will put down. Often, if you have children, you will get to claim your children or others as dependents, which reduces your taxable income. And so if you claim allowances, it's going to mean that your employer withholds less money out of your paycheck, so your paycheck is bigger. But it means that in the end of the year, if the employer hasn't taken out enough, you could end up owing taxes in the end. This is why tax planning is important, to know what your expected tax liability will be and how much you should claim. We're not going to get into too many details of this. If you take a tax course, that would be a good place to learn about that. But we see here on John Wick, his last name, his W-4, he has claimed 0 allowances. So, where do we go from here? Well, once we know this information, then we can determine what his federal withholding should be for income taxes. And we can do that in one of two ways. We can use the percentage method, or we can use the bracket method. They both should get us basically to the same answer, but one's a little bit easier to follow than the other. Both of these methods are available in a publication put out by the IRS called Publication 15. Publication 15 includes the wage bracket method and the percentage method. I've included, down below here, some snapshots of that document. So, here's the percentage method. The percentage method tables for income tax withholding. If we are going to do this method, we use this table. Now, why is it this table? Well, this table is for weekly payroll periods. People who get paid weekly, which we said he did, our employee. Is he married or single? Well, we said he was single, so we're going to use this side. And it says, if the amount of wages after subtracting withholding allowances. Okay? After subtracting withholding allowances. So, how much are we going to subtract for his withholding allowance? We're going to subtract 0 because he didn't have anything selected. Okay? So, where are his wages? Well, his wages fall here, between these two numbers, right? His wages of $1,200, right? If you remember right, $1,200 fall below 832, or fall between 832 and 1692. So it's over 832, but it's below 1692. And so we're going to use this row, which means he is going to pay $87.34 in tax to start with. Okay? So we're going to look at his federal income tax withholding. We know he's starting with $87.34. Okay? Beyond that, he is going to pay 22% on whatever amount he made that was over $832. So if he earned $1,200, the amount over $832 is $368. And he's going to pay 22% on that. And so 22% of $368 is $80.96. So his total federal income tax withholding is going to be $168.30. So that's his total amount. That's the percentage method. It gives us a pretty accurate number based on the information that is provided to us. Now, this table that we're looking at is the table for 2019. Each year, tables change, but for now, this is the number we're going to use. The bracket method is a little bit easier because we know that he makes $1,200 per week and he's a single individual. And so we go to the bracket method and we say, all right, well, the wage bracket method for tables for income tax withholding, single persons, right, weekly payroll, we got the right table. And we look, this is not the first page of this table, but this is the page his information is going to fall on. If we scroll down, we say, all right, where does he fall? Well, he made $1,200. So if we go down the list here, we get to $1,200 right about here. Okay, so between $1,195 and $1,206. So if he gets paid $1,200 a week, and he's between $1,195 and $1,206, that means we should withhold how much from his pay? Well, this table, these columns up here, he selected 0 allowances. And so this is the column of the table we'll use, and it puts us at 168. So we calculated it to be 168.30. This table doesn't have cents on it, and so we just have 168. But it's pretty close. So we go back up to our situation, and we see that under the percentage method, the bracket method, our federal income tax is 168.30. So we've got two numbers here now to deal with, the FICA tax and the federal income tax. So how do we record our payroll then? Well, let's make a journal and see how it works. So here we have a situation. Let's just say we're going to get paid 4/1 of 19. The wage expense that we record is the amount that the employees have earned. In this case, $1,200. But we have FICA taxes that we owe to this respective program, Social Security and Medicare. And so we have a liability. We have to forward on $91.80 to those programs. We also have to forward on to the federal government John's income taxes that we've withheld from his paycheck. And that is $168.30. And so his net pay, how much we're going to give him in cash, is going to be $939.90. And so we have our journal entry. Now, we would make this journal entry for all of our employees, right? In this case, we're just looking at what John's specific situation would be. Now, this is what we typically refer to as the payroll journal entry. The payroll journal entry is all about the employees. Okay, what they're earning and what we are withholding from their pay. But this isn't the only thing employers have to deal with. Employers also have to record what is called the payroll tax journal entry. This is for the employer. The employer has to pay taxes because they have employees. And so we have another journal entry to record. We are going to record payroll tax expense. Now, it's made up of a couple of things. Employers have to match the FICA taxes that employees pay. So, because John Wick is going to have to pay $91.80 in FICA taxes that we as his employer will take out of his pay and send to the government, we also have to send $91.80 out of our pocket, the employer's pocket, and send it on to the government for those programs. So we, as the employer, have to match what the employee has to pay. In addition to FICA taxes having to be matched, employers have to pay two other kinds of taxes. We're not going to get into a lot of great detail on these two types, but it's important to understand. employers have to pay FUTA and SUTA. These are federal unemployment tax and state unemployment tax. Now, rules for states vary, but we're going to talk about federal mostly. So, scrolling down here toward the bottom, this comes from the IRS website. We are looking at the Federal Unemployment Tax Act tax rate. The FUTA tax rate is 6%. The tax applies to the first $7,000 that you pay to each employee as wages during the year. The $7,000 is often referred to as the federal or FUTA wage base. Generally, if you paid wages subject to state unemployment tax, you may receive a credit of up to 5.4% when you file your Form 940. We're not going to talk much about forms in this video, but there are forms that have to be filed with the government. If you're entitled to the maximum 5.4 credit, the FUTA tax rate after credit is 0.6%. So basically, if you pay state unemployment taxes, then you can get a reduction in your federal unemployment tax that you have to pay. So let's go up and look at an example. We'll use John Wick here. If John Wick just started with us, he has not yet earned $7,000. So once an employee earns $7,000, then the company does not have to pay unemployment tax for that employee anymore. But let's say that he has not yet earned $7,000, and so we are going to have to pay how much for FUTA, how much for SUTA? Well, it depends. If we pay SUTA, and we pay our state of 5.4%, then we're going to pay state unemployment taxes of $64.80. If we pay our state unemployment taxes, we get the credit for the federal, which is normally 6%, but now gets reduced down to 0.6%, which means we pay $7.20. And so we have federal and state unemployment. The key thing here to recognize is that this does not come out of the employee's pocket. This comes out of the employer's pocket. And so it's part of the payroll tax journal entry, not part of the payroll journal entry. So federal unemployment tax payable, how much do we owe? $7.20. The state unemployment tax payable, how much do we owe? We owe $64.80. And so in total, we have to pay all of this out of our pocket as the employer. It does not come out of the employee's pocket. And so what's the total amount of payroll tax expense? $163.80. And so when we look at this in terms of our employee, what is the total payroll cost to the employer? For the employer is going to have to pay a total of $1,363.80 for this weekly payroll. Right? It's not just the $1,200 that the employee earns, because on top of the employee earning $1,200, we have to pay $163.80 in taxes. The employer does, right? The employee, right, the taxes are taken out of his earnings. But on top of that, right, the payroll journal entry, the payroll tax journal entry, right, we have different things happening here. So this is an overview of payroll taxes in terms of payroll tax liabilities. Where are our liabilities? Well, we have FICA tax payable, federal income tax payable, FUTA payable, and SUTA payable. These are liabilities that are on our balance sheet, right, related to our employees.